Europe has a problem it can no longer hide, and the clearest warning signal is Germany. For decades, Germany wasn't just another European economy. It was the engine of Europe, the manufacturing core, the export powerhouse, and the fiscal anchor that kept the euro area stable. But today, that engine is slowing down. Not because of one leader or one election, but because the economic model underneath Germany is under pressure from every direction. And when Germany slows, Europe slows. And when Europe slows, global markets feel it. Let's break down the structural forces behind this shift. Germany's modern strength rested on three pillars: cheap Russian energy, strong export demand from China, and a stable, predictable economic environment inside Europe. All three have weakened. Russian gas, a backbone for German industry, collapsed after the invasion of Ukraine. Energy-intensive sectors are still adjusting, with higher input costs becoming the new normal. China, once Germany's most important export customer, has changed too. Beijing now produces much of the high-end machinery, autos, chemicals, and industrial components it used to buy from Germany. Competition has replaced dependence. And across Europe, growth is slow. Infrastructure needs are rising, and competitiveness gaps are widening. Germany is no longer sitting on a strong regional base. It's sitting on a fragile one. You can see the effects across the economy. Growth forecasts for next year have been cut to below 1%. Domestic-focused equities have underperformed stronger global markets. Several large German firms have announced restructuring or cost-cutting measures, and key industrial indicators have struggled to regain momentum since the energy shock of 2022. But the most important macro signal isn't any single data point. It's Germany's fiscal pivot. Germany, known for its strict fiscal discipline and its legally enforced debt brake, is now committing to some of the largest public investment programs in its modern history. Not because it prefers a spending model like the US or the UK, but because the alternative is long-term stagnation. The $500 billion infrastructure and modernization plan is not aggressive stimulus. It's defensive spending, an admission that without major public investment, Germany's old growth model cannot deliver the results it once did. This is the part markets may still underestimate. When the most fiscally conservative major economy in the world is forced to rethink its own rules, it signals deeper structural challenges underneath. And those challenges have global consequences. A slower Germany shifts the macro landscape. It weighs on the euro. It weakens Europe's manufacturing demand. It affects Asian export orders. It tilts more global capital toward the United States. And it reduces Europe's ability to exert strategic influence at a time when geopolitical pressure is rising. Germany doesn't need a crisis to matter. Stagnation alone is enough to move currencies, investment flows, and global risk pricing. The timing is also important. Next year, Germany's large economic programs, covering infrastructure, energy transition, and industrial renewal, begin rolling out more visibly. If these initiatives deliver results quickly, confidence can stabilize. If they don't, Germany risks a drawn-out period of underperformance, where growth remains weak and fiscal pressures rise. This is the real macro story, not the political headlines, not the noise. It comes down to a simple question. Can Germany rebuild a competitive model for a world where cheap energy is gone? China is now a rival, and Europe is growing more slowly. That transition will shape the entire continent and will influence global capital flows far more than most investors realize. We'll track those structural signals here. This is Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell. We're building the strongest macro community on the platform, one signal at a time, together.